Joining me in studio is our market expert today, Thomas Hayes. He's the chair and managing member at Great Hill Capital. Thomas, great to have you.
Great to be here, Kristen.
So a lot to digest, of course. Choppy but higher start to the year. Now this inflation report, stocks set to drop about 1% at the open. What are the takeaways?
Well, I think a couple of things. I think Goldman Sachs and JP Morgan set up the street. They said if it came in this hot, the market was going to be down 1.5% to 2%. It's kind of consistent with the February seasonality. This is the second worst month of the year historically, and in a post-election year, February is down on average 1.3%. So I think we got to buckle up, Buttercup. This might be a little bit of turbulence here for the next few weeks. There will be a knee-jerk reaction to the inflation report. 10-year yield was at 480, went down to 450. Now it's back at 463. Do we go back and test 480 again? Maybe, maybe not. We're not going to 5. Bessent and Trump have already said they want to target the 10-year yield. So I think actually what you're going to see before we get to 5, we might actually move to 4 because there are deflationary actions in place, namely with Doge. They are cutting costs with a machete. They're laying off a lot of people. That's going to be deflationary. That's going to hurt the jobs market a little bit. That will offset, but we're not going to see that right away. So right now, it's an immediate knee-jerk reaction to inflation, and we're going to see that today.
Yeah, so just in about 2 hours, 1 hour, I guess, we'll hear from the Fed chair here on the East Coast. But I am curious, Thomas, how tariffs factor into this, because since the last time we spoke, we have heard a wave of tariffs announced by the administration.
Yeah, if you look at the effect of tariffs historically, you do get a short-term pop in prices. Intermediate term, it normalizes. And actually, if you look at washing machines and so on, shortly thereafter, actually prices are lower a couple of years out. So it's kind of a short-term impact in terms of the tariffs. Again, volatility that we're going to see here with the new administration, and new headline every day. Welcome to Trump 2.0, same as Trump 1.0, a new tweet, a new set of volatility.
So let's talk about some of your picks within the backdrop of this market.
Yeah. So when we came on early this year, we said that this is going to be a different type of year. Mag 7 is not going to be the leader. We're going to see broadening. Well, what has happened in the first 6 weeks here? The 493 equal weight has outperformed the Mag 7 cap weight, so that's new. Europe equities have actually outperformed U.S. equities, and value has outperformed growth. 3 things that weren't on most people's bingo cards, but they heard it right here on Kristen Scholler's show live at the NYSE. So that's going to continue. So what's up next? I think what could be up next is small cap starts to outperform large cap, and emerging markets start to outperform developed markets. Why? Because you're getting earnings growth for lower multiples in all those areas that are starting to broaden out and starting to outperform. This inflation report is going to be an opportunity for dividend yielders. So yields are going to blow out. They're going to get sold off in the next couple of days, and then you want to buy some of these defensive stocks. One that we like is Crown Castle. It has a 7% dividend yield, 40,000 cell phone towers. They are a leader in that business, but what's been holding them back is their fiber business is very capital intensive, takes a lot of investment and a very low return on that investment capital. They're selling that off to Zio Group for $8 billion. That'll enable them to buy back stock, pay down debt. It'll be a great thing for shareholders.
7%, pretty impressive, right? Especially in this environment where high yield savings is maybe yielding you 3.5%, and bonds would be lower as well.
Correct. And you have capital appreciation potential once they get rid of that albatross around their neck. This stock can really move up quite a bit. So you get paid while you wait. You get some capital appreciation over the next 2 years. The next couple of days, use this opportunity to take advantage.
What does this mean for deals?
Yeah.
The overall market.
Look, this market is primed for a lot of IPO paper in the next 12 to 24 months. In the short term, you're probably not going to get your deal out in the next couple of weeks. We're going to have a little rockiness, a little bit of volatility. Another defensive stock that we're looking at in this context is Hormel, the maker of Spam, of all things, Spam, Hormel chili. All the protein snacks that people need whether they're just normally eating or whether they're on GLP-1s, which is the new trend. They want high protein stuff, Skippy, Planters, etc. This has been kind of mismanaged since 2016. That CEO is leaving, Jim C. It's got a 3.7% dividend yield, and they've been raising the dividend every single year for 59 years. It's a dividend aristocrat.
Now that is a serious track record,
That's right. 59 years is a long way.
So let's talk a bit about bonds. Thomas, I know
Yeah.
you mentioned obviously dividend stocks.
Yeah.
How do bonds look to you at these levels?
Yeah, so I think you'll get this knee jerk. You're going to get an intermediate term sell off right now. 10-year yield's probably going to go back up to 480, somewhere in that neighborhood. Any weakness in bonds is to be bought. Okay, the deflationary forces of Doge and cutting and et cetera, and the slowdown that could be short-term impact of tariffs, you could get a slowing of growth as well, will be an opportunity to buy bonds. Right now, there were two crowded trades coming into this year. Number one was long Mag 7. What's been the worst performer? Mag 7. The second most crowded trade is short bonds. Everyone's shorting bonds in the hole. Today they're going to feel smart. In 4 weeks, they're not going to be so happy.
Interesting. Yeah. So would you buy the dip?
In bonds, for sure. In the next few days, I'd be buying bonds left and right.
If we see underperformance in February, historically, which is what happens, what about that for equities?
For equities, for sure. This is where you want to get out your shopping list. In the next 2 weeks, you're going to have opportunities to buy great businesses. It's no impact. This will be a tiny little blip on the screen when you look back three months from now. Use this as an opportunity. This is how you make money. You don't sell in the hole, you buy in the hole when you're buying high quality businesses, Kristen.
Thomas Hayes, Chair and Managing Member at Great Hill Capital. Thomas, always a pleasure, and thanks for joining me in studio.
Thanks for having me.
Great to have you.